Hello, everybody. So hopefully you are all tuned in. As per the chats there, welcome to, I guess, our virtual investing roadshow. I will give it a couple of minutes before we kick into things. We do have live chat running, so if you can hear me, just let me know that everything's working okay, because I don't have my sidekicks with me this evening. We've only just landed back from Christchurch, where we had been parked up for a couple of days. Obviously, we managed to finish our Christchurch Roadshow, which was, I think, about day 10 of our nationwide tour. And obviously the COVID news hit. So we were parked up for a couple of days, obviously making the most of the Kernel jumpers. We are now back safe in Auckland, and so we thought we would host this. If you are settled in at home, obviously, wherever you are in the country, do chat us, let us know where you are. Make sure you've got a cold drink. In a couple of minutes, we'll kick into it. So I guess some context as well for why we were on the road. Last week was the Commission for Financial Capabilities Annual Money Week. And so that's really about trying to grow financial literacy awareness and really engage in the conversation around investing, money management, debt, all those key issues that we probably don't talk about enough. And so we decided actually we want to play our part in that. So we hit the country, we started traveling around the North Island, and we obviously just hit the South Island, had a few more events to go. And so now we are virtual. So for those of you who we didn't get to meet in person down south, welcome. Do say hi. I can see your chats coming through, so let us know where you were. We had a fantastic time seeing people over the past week or so. And obviously, I think the challenge for me tonight now is I don't get to see you face to face. I can't have a chat with you in person, but we will respond to all questions. Throughout tonight's event, I will answer questions as we go where it fits in, but we'll have plenty of time at the end as well. So if there's anything you really want to talk to, we will cover it. So we'll just give it a couple more minutes, folks. Like I said, make sure that you have got a drink, that you're all settled in. I'm sure that you've hopefully relaxed a bit after day 2 of being at home. It was fantastic, I guess, seeing when we were traveling back to the airport and even just flying over Auckland coming in, how few cars there were on the road. So it's great to see that people obviously clearly doing their part. So for us, we made it back this evening. Welcome Johnny and the team from the Happy Saver down in Alex. We were really looking forward to coming down and seeing you guys for a catch up. So we are going to kick off. Like I said, do keep sending through these chats. I will try and do my best to keep across them as we go. And hopefully, as you can see, I'm trying to be really multitasking here. We've got this lovely little clicker so that I can manage and point to things as we go. For those who are tuning in, there are some slides that we'll go over tonight. If you can't see everything on them, if you're watching on mobile, you just want to listen in, we will send you a copy of these after. So do reach out to us if you'd like some of the slides, and we'll make sure that you get a copy of those. So our investing roadshow. As with any sort of investment event or any sort of conversation, you are going to get some form of disclaimer. So I guess the broad thing about tonight is that this is not advice. And I guess a testament to the last couple of years is no one really can predict the future. Not only do the last couple of years really reinforce that, but if you look at any economic forecast, if you look at any forecast around changes in the OCR, they are wrong more often than they are right. Make sure that you do your own research, and obviously with any investment decision that you make, read the offer documents. So in the case of New Zealand, that will be what's called the product disclosure statement. That's got all the key information that you really need. And from there, there'll be supporting information that you can find from any of the providers. One of the things that's probably now more relevant than it ever has been is you'll often hear the statement that past performance is not indicative of future returns. We're going to really highlight why that's the case, why that really is. We're in this unusual period and you shouldn't be making decisions based on advertised investment returns. And on all of that, do feel free to ignore anything that I'm saying. Obviously, this isn't advice. I don't know your personal situations, but I would love to answer as many questions that you send through as we can tonight. So keep firing them through. Some of you that are watching it and tuning in will obviously be Kernel customers, which is fantastic. Again, unfortunate that we couldn't get to meet you in person. I had a fantastic week on the road, obviously seeing some of our customers from day one and some of those who are very recent joined us to our platform and have actually seen the change we've gone through ourselves over the last 18 months. So if you're not familiar with who we are an online investment platform. We run a range of index funds. So Kernel, we run the index funds ourselves. We're a licensed fund manager. I guess we're really passionate about growing the financial well-being and the financial wealth of all Kiwis. We are trying to embed good savings and investing behavior for everybody. And I guess as part of that, we really take a long-term view with everything we do. Everything we've built, the platform, the products are all designed around long-term wealth building. That's really what we stand for. That's what we're passionate about. And we'll try and make that as efficient and easy for everybody. I guess as part of that, though, as well, we really take our role as a corporate citizen seriously. We are a living wage employer, and also we offset all of our carbon. So while we're entirely digital, there is still the occasional footprint that we have to manage, and so we do offset that as well. So let's get into it. I can see a number of exciting questions coming in already. So the past 18 months, it really has been a pretty unusual period, right? This has been unprecedented in the sense that this was the fastest 30% drop ever in equities. Equally, one of the fastest recoveries. We have got unprecedented growth in house prices. We've seen the rise of cryptocurrencies, meme stock investing. And as I mentioned at the very beginning, we've also had phenomenal returns. We have come off significantly lower investment bases. And so it's not unusual to see advertised investments out there with 100% plus returns. And I guess the key thing for me here in this very first point is just really resetting expectations now. We've started from this low base. We've started from the bottom of March last year. It has been a lot of opportunities out there to go and make, I guess, quick wins. And we've seen significant investment returns advertised on the back of that. But that's not normal. And I guess the things we want to talk to you about tonight are, well, what should you be thinking about for long-term wealth building? What do you think about now in this back into some sense of normality as we look forward to the decade ahead? Well, one of the really interesting things as well, and this is already having fun with multiple clickers, one of the really interesting things over the past 18 months is we've seen a real rise in engagement around investing. Now, this is fantastic for New Zealand, particularly given our historic obsession with investment properties. But there's been some interesting behavior around this. We've seen, obviously, the rise of meme stock investing. I guess for those that aren't that familiar with what a meme stock is, it's really where it surged in viral activity, fueled by online social media. And so there's a couple of great examples that we've seen globally around this, AMC and GameStop. There's been some fundamental reasons as to why this has occurred around investors trying to create what's called a short squeeze on hedge funds. But I guess why have we seen such engagement with investing? Well, I just want to take an example of New Zealand. So the two tables there that you can see, the top one in blue is March and April and May of 2020. The bottom is March, April, May of 2019. And it highlights how phenomenally, I guess, volatile the markets were and how big the swings were. So in March and April in 2019, the largest single intraday movements of those months were between sort of 3 and 4%. If you look at that in March and April 2020, now we're talking 25 and 26%. So 25% movement within a single day. So there were obviously opportunities out there. Not only did things fall significantly, but there were opportunities for some quick wins. We saw that when it came to Google searches. So the little bar above, again, you may not see the numbers there, but that was the monthly searches for Air New Zealand shares. So March, April 2019, it was nearly 1,400 searches across those 2 months for Air New Zealand shares. In March and April of 2020, that was 94,000 searches. So significant change of engagement. As we're locked at home here, again, a bit like now, there was something interesting to do. There was a lot of activity going on and there were some opportunities. And I guess what's really interesting about this, though, is this is a global phenomenon. This isn't just unique to New Zealand. This happened around the world. And we can actually see that in terms of the types of stocks that companies were holding and platforms were trading in every market. So the bottom table there now, these were the holdings of a Canadian online trading platform. So you see same sort of companies, same sort of activity. So this is the recent holdings. This was as at, I think, of June, obviously there for both of those. So you can see Air Canada, AMC, GameStop, Tesla. So these names that have been highly talked about over the past sort of 12 to 18 months. So obviously that's been some opportunities, there's been some quick wins, there's also been a lot of risk, and probably some of those coming a bit late. And now what? Well, let's just step back and have a look at some of the unusual activity that has occurred. GameStop is a great example, I guess, of where we've seen some really interesting behavior. Now, what we've never had before in our history is the combination of social media and online trading. There have been plenty of periods where we've had, I guess, increased everyday investor engagement with the share market. In case of New Zealand, we've seen this going right back to the 1800s when we've had gold rush and other periods where there was significant trading going on with stock exchanges at the time, which was spread all around the regions of New Zealand. But GameStop's a really interesting one. For those that aren't familiar with GameStop, it's a bricks and mortar store that sells games, etc. Now, there was a real surge when obviously there was investors were collegiately got together through social media to try and form a short squeeze on hedge funds who had sold the stock short. But I think one of the really interesting behaviors, or one of the interesting dynamics that can occur with the sort of meme stock and these sort of behaviors and the power of social media actually occurred a little while after that. Now, Ryan Cohen, he has built his wealth previously with online businesses, but he was a reasonable shareholder. From memory, I think he had around 8 or 10% of GameStop shares. Now, what's really interesting here is he doesn't normally tweet, and all of a sudden he sent that tweet out, the McDonald's ice cream cone and a frog emoji. What does that mean? Doesn't tweet for ages. Well, in the world of charting, there's a thing called moving average convergence and divergence. This is where people look at stock market charts and the price movements to try and predict the future. Now, in that world of people who like to chart, when this moving average convergence divergence, MACD, goes from being overbought to oversold, it goes from being purple to green and is known as going froggy. So you get where we're going with this. McDonald's ice cream cone with a frog emoji, MACD and frog emoji. Within, obviously, as you can see, a couple of hours, significant spike on the back of a picture of an ice cream cone in the value of GameStop shares. And in fact, Ryan Cohen's holding, which already was astronomically high after the previous surges, went from about 450 million US dollars to nearly 1.1 billion. So within a matter of hours, a tweet of an ice cream cone was able to, on paper, create $500 million in value. That was some of the unusual behavior that we've seen. And look, we shouldn't be surprised about the power of tweets, I guess, up to the past sort of 5 years of activity we've seen out of the US. But let's step back from that a bit. Obviously, as mentioned, we have seen some unusual behavior over the past 12 to 18 months. It's been an interesting period in the history of markets. There have been all sorts of things going on, but we've had all sorts of different activities previously as well. There have always been different facets that have driven the market, from the dot-com bubbles to Asian financial crisis. There were always new dynamics to deal with. But stepping back and taking a bigger look at what's been going on, well, we're at record low interest rates. Back then near zero. And actually, pre-COVID, there was a lot of conversations between the Reserve Bank, IRD, and others, including fund managers like ourselves, around, well, how do we prepare for actually the wholesale interest rates in New Zealand? What happens if they go negative? So we've had 40 years of declining interest rates. We've had the rise of inflation over the past sort of 6 months. And obviously, for many, we've got increasingly inaccessible housing. And on the back of all that, there is just a lot of cash in the world. Now, these falling 40 years of interest rates have created some real challenges for investors. I guess over that 40-year period, falling interest rates for a lot of assets has been great. It's been a real tailwind, not only housing, but share stocks, etc. All have benefited from falling interest rates. But when rates come to zero, what do you do as an investor? What should you be thinking about? Now, one of the really interesting things is the different demographics and where they are at their investing life stage. If you'd gone and seen a financial advisor over the end of this period, you very likely would have got what's called a 60-40 portfolio, otherwise known as balanced. That's where about 60% of the investment went into growth assets, being stocks, and 40% went into income assets, think bonds and cash. term deposits, for example. Now, why have you had that? Well, the great thing about mixing those two assets together is that over that period, you've been able to generate about 90+ % return of just investing in equities, but with nearly a third less of the volatility. That's the benefit of the combination of combining those income assets and the growth assets. Why has that worked so well? Well, as interest rates have fallen, the value of the bonds in that income piece has also gone up. But now we're at this new point. Well, what happens when rates start rising? That could actually cause the fixed income assets to also fall in value. It also poses a lot of challenges, particularly for people who are after an income or a passive income source while they're in retirement, or just to fund their lifestyle. And I guess to give some context to how much things have changed, let's just have a look. This is a look at the last 4 decades, and it gives some sense of how things have changed for investors. So this was the 6-month term deposit rates. This was the average annual earnings as at those points. And this is the amount needed to invest to generate the average annual earnings. So you see now, you cannot generate a passive income source with money just sitting in the bank anymore. You do need to think about alternatives. This is forcing people in retirement to be thinking about how they're going to fund their own retirement, how they're going to prepare for retirement. And I guess the big picture of all of this is where interest rates are at. What we're seeing with house prices is that you cannot get ahead by simply leaving your money in the bank. You do need to take some form of action. You need to think about investing. So the real challenge here, and I guess for some scale as well, there is currently over $250 billion sitting in New Zealand term deposits and on-call bank accounts. Just think about that. The amount of money that's sitting out there in New Zealand right now, that with inflation and after tax, that's actually losing value of a couple of $1 billion a year in terms of purchasing power. Now, the money that's sitting in the bank is going backwards. And so for a lot of people, you do need to start thinking about, well, what's next and how are you going to prepare for the future? So that's a bit of an overview of what's going on. Look, I love the passionate people about GameStop here. It is a whole other world, obviously, when we're talking about meme stocks. So that is something we'll talk about separately later on in tonight's session. But we're going to cover a few things. We're going to talk about indexing versus active, investment strategies, paying off the mortgage or investing. We're going to touch on sustainability and sustainable investment strategies, some alternatives, and obviously Q&A. But I am happy to answer questions as we go. I guess for a couple of you there that may not be so familiar with who Kernel is, this isn't about Kernel. We're not talking products tonight. I'm happy to answer some questions at the end on that. But this is really about talking about these key investment points to think about over the coming year. So, indexing versus active. I guess the key thing here is, what is an index? Normally this would be the opportunity where I'd ask those in the room to actually raise their hands and say, who actually knows what an index is? So if you do know what an index is, feel free to comment now. Kernel is an index fund manager. We run a range of index funds. One of the index funds we run is an NZX 20 fund, and that tracks what you can see in the middle of the screen there, which is the S&P NZX 20 index. What is an index? Well, the line that you see is the index over the past, the return of the index over the last, whatever it may be, was that 14 odd years to the launch of the S&P NZX 20, which was back in 2007. What is the NZX 20 index? It is really, in short, just the collective return of the 20 companies that are in that index. So you can think about an index just being a measure of the collective performance of the companies that index represents. You may be really familiar with the S&P 500 or the NZX 50. The S&P 500 is just a measure of the collective performance of the top 500 largest companies in the US. Now, you can get all sorts of indices today. There are 3 million odd indices calculated around the world. I think S&P Dow Jones Index is one of the biggest. They actually calculate 1 million indices themselves every single day. Now, indices have actually been around for a very long period of time. The first index was developed by Charles Dow and Edward Jones. Now, that was back in the very late 1800s. They were actually two journalists. And it was developed basically to summarize what had happened in the markets without having to go report on every individual company. So the index is simply a measure of a part of the market or a group of companies, can also be bonds, etc., and their collective performance over time. A lot of the really common indices that you see, like the S&P 500, are what's called market capitalization weighted indices. That basically means the bigger the company by value, the bigger the weighting it has in the index. So as an index fund manager, we're basically a data company. Our job is to deliver investors the performance of the index, what you see on the screen. We do that by buying the companies in the same weighting that they're represented in the index. There's a lot of nuances to it, but our job is to replicate this index as closely as possible. Now, a couple of numbers that you'll see on the screen there. In case next to the S&P NZX 20, you will see this little 7,000 number here. What is that? Well, it's actually nothing really. It's arbitrary. It's a number that's set when an index is launched. The number itself doesn't really mean anything. What you have in this case, that would have been the performance for the day. So you'll be able to see that in the news, in the paper, or online in real time. Obviously, green is better than red. But the number here itself, the index value, that's just a number that's set when an index is launched. And what you'll care about as an investor is how that number changes over time. So there's two ends of the investment spectrum. There is index investing, which is what Kernel does. And then at the other end is active management. So active management is all about trying to select stocks. And that's basically where they hire a bunch of research analysts and they're trying to find the individual stocks that outperform the market or the part of the market that they're looking at. What we've seen over the past couple of decades is a real rise in index investing. So in the US now, about 30 to 35% of the market is held in index funds. Why have we seen such a shift towards index investing? Well, I'll make this a bit bigger for you. Performance has been one of the reasons. This little chart here, and you can go to this website, which is in the bottom here. This is SPIVA, S&P indices versus active. What we see on the picture here is basically a snapshot. If you go to the website, you can really drill down into each country over different time periods. But what you're seeing with this is the percentage. Each bubble is the percentage of actively managed funds that underperformed an index over that period. So you can see it's pretty high, right? The odds of finding an active manager that do better than the index are very low. Now, you can actually go to longer periods of data, like in the US and Australia, they have 20 and 25-year plus returns. And that starts to get into 90 to even sometimes 95%. So obviously, investors have started to realize, why are we paying so much in fees to active managers for them to ultimately underperform? And that's created an interesting dynamic. So obviously there are a range of active funds out there. The debate around active versus passive investing has been going on for a very long period of time. In fact, we would say it's since the birth of index funds, which was actually in the 1970s was the first index fund. And over that period, there's been a lot of industry debate and public debate between the benefits of active, the benefits of passive, and which one is better. That spurred a lot of media coverage. But what's really interesting is if you go and Google the dangers of passive smoking, you get about 3 million hits. If you Google the dangers of passive investing, you get nearly 28 million hits. Why do we see such a significant number of hits for passive investing? You know, only one of these kills you, right? What's this number down here? This is the value, the estimated value of savings that US investors have made having switched from actively managed funds to index funds over the past 25 years. That's the savings and fees alone. So that money used to go, this $509 billion used to go into the pockets of actively managed fund managers, active fund managers in Wall Street. Now it remains with investors. Now, instead, it sits in the pocket of the investor, not eating into your returns. So obviously, that's a significant hit to Wall Street. And one of the really interesting things, there was a lot of talk about investing in GameStop and others, as a attack on Wall Street and to take down the institutions? Well, fundamentally, investors shifting from actively managed funds into index funds has had a far bigger disruptive impact on Wall Street. Index funds has been one of the most fundamental changes towards the financial markets over the past century, and it's having a significant impact on the institutions who still charge high fees. What we see now as well is that number continues to grow quite substantially. So if you think about this has obviously started when 25 years ago, only about 5 to 7% of the market was held in index funds. Now at about 30%, this number grows by over $50 billion a year. One of the questions here, and I will answer it now, is what happens if all the money is invested in an index and not via managed funds? Isn't the index dependent on individual stocks purchased by managed decision, active decisions? This is a really great question. I actually had this at our event in Christchurch yesterday. So the key here and to think about it is there's a difference between ownership and trading. Now, index funds typically buy and hold. They don't trade the companies very often. What they do is they'll buy and hold companies in part of the market or a portion of the market. It's the active trading of stocks that sets the price. This occurs in real time throughout the day. Now, as mentioned at the start, index funds currently own about 30 to 35% of the US market. In New Zealand, domestic index funds own probably 5 or 6%. Now, we need to separate those two things. Index funds don't trade very often. Most of the trading activity on market is done by institutions. 90% plus is done by institutions and pension schemes and active fund managers. It's estimated that index funds in the US account for probably about 8 to 10% at current. What you need to be thinking about is, well, at what point does index funds owning so much of the market actually start to cause an impact into the trading activity? If you model that out, you can get to estimates by a number of sort of research providers on this have got to about 80% of the market could be held by index funds before you actually get to about 50% of the trading volumes on the market are done by index funds. So we're a long way away from that. And a real practical example, just think about Air New Zealand. We mentioned it at the beginning. Air New Zealand is 51% owned by the New Zealand government. You could almost think about that as like an index fund. It is a buy and hold position. They don't really sell their shares. Air New Zealand's share price, you would argue, is not mispriced. You know, it is changing every single day. It's the active trading of those shares that set the price and the value. The fact that half of it is owned by a buy and hold investor isn't impacting its valuation and the price discovery of those shares on market. So you can separate those two things out. I think it was just a key point to make here before we kind of move on. Now, the most technical chart of the night, and I will make this big for you. Now, this is the most complex. Piece. And I guess just quickly to Darren's point, they were just examples of active managers, and I'll talk why as to where they were positioned on that chart in a second. This is the one piece of math that we're going to talk about. And what we really wanted here is to highlight, not only do people often look at the performance outcomes of the active versus index debate, I think it was important to touch on, well, why? Now, one of the fundamental reasons as to why we see so many actively managed funds underperforming is cost. You know, on average, actively managed funds cost more. That's a hurdle that they have to overcome just to get onto the level playing field of what an index fund will deliver. But there are some real mathematical things around the market that actually make it challenging to pick stocks. So what we have here is plotted the return of all New Zealand listed companies between December 2003 and December 2019. So if you look at it there, companies can only go down negative 100%. They've gone bust, but they can go up 10x, right? So companies, this is the percentage of companies that investors would have received over that period a return of negative 50% or in some cases gone bust. And that's nearly 17%. You know, that's pretty high probably for most people. About 17% of companies over that period, negative 50% return or bust. What's interesting here, so this is all the companies and how they fit into each bucket. What's interesting here though, here's the median. The median return from all New Zealand listed companies over that period was 62%. That means half of all companies gave investors a return of 62% or less. The average was nearly 5 times that. The average was 248%. The average is pulled up by these companies as 5% of that did 10x. If you can find somebody that can pick these 5% of stocks that do 10x, pay them as much as you like. You will make a phenomenal return. Costs don't matter, but it's really hard to pick those companies. It's really hard to pick them in advance, and it's really hard to buy and hold them for the period that you need to see that sort of return. So today, is it going to be Apple that does the 10x going forward, or is it another company? These are the challenges, right? But what's fascinating here is picking stocks, and why active management is so hard isn't a 50-50 game. It's not a 50-50 chance that a randomly chosen stock will do better than average. In fact, if we look at this here and you add up each of these bars, about 75% of New Zealand companies over this period gave investors a return worse than average. That basically means you only had a 1 in 4 chance before you even get started of picking a stock that does better than average. This is one of just the simple mathematical reasons to why active management is so hard. The shape of this graph is the same around the world. We see this time and time again across equity markets. It's a dynamic of how companies return over time. This also is why you'll always hear the conversation around diversification is key. Because randomly selecting one stock, you have a 75% chance, basically, that you would have had a stock that performed worse than average. Why you need to have diversified portfolios to try and ensure you get some exposure to this 5% of stocks that really do 10x. This is why indexing works, because indexing ensures that you get some exposure to these companies up here. And this exposure is what ensures that your return is average rather than back down here. So that's the most complex sort of mathematical piece of the market, of the conversation tonight. If you've got any questions on it, happy to dive into that at the end. But it's quite simple. It just really reinforces the challenges of picking stocks and why diversification is so key. I will come back to your point, Bruce, at the end if we get some time. I'm more than happy to dive into that. I'm coming back to, though, the image that I had before. Look, I think one of the really interesting things that we see is that we tend to often have these conversations like it's binary and you can only have one or the other. And that's common within the financial services industry. They tend to say we're one extreme or the other. There's not actually, there is the benefit of both. And that's what we would call core satellite investing. This is really common overseas, particularly in the US. We don't see too much of it here, but it's basically how do you get the best of both worlds? So the core satellite investment strategy, what you do is put the core, and that could be any percent, maybe it's 50%, 80%, into low-cost index funds. That's going to ensure, this is the key here, this is your core, low-cost index funds. That's going to ensure that you get to your long-term wealth objectives. In fact, the index funds are all you actually really need to get to those long-term objectives. You're going to get the market return over time. You'll get to the long-term goals. The satellites are the more smaller positions, but this could be direct stocks, it could be cryptocurrency, it could be private equity, it could be actively managed funds. These could be a couple of percent into things that you're really passionate about. Maybe you really care about researching stocks, or you're really passionate about a certain asset class or a strategy. That's fine, spend all your time on that. The core, and the nice thing about the core is actually once you've set it up, that's pretty much all you need to do. It is really kind of a set and forget. You can leave it. It's a long term. It's going to do its thing. The key here is that you're not betting your entire portfolio, your entire long-term wealth onto these more speculative individual positions or your satellites. And I'll give some examples as well around how index funds could be classified as satellites as well. So I will continue on here. We've obviously got a couple of questions coming through. I will touch on the low cost piece because obviously that's pretty relevant here. So hi, Nathan. How do you find low cost? VOO has a 0.03% expense ratio compared to similar exposure. Well, actually, it's some at Kernel. Yes, we do have thematic funds at 0.55, but our lowest fund actually is 0.15 for investors over 25,000 after our rebate, which I'll touch on at the end. There is just the dynamics of scale. And I think there's a lot of talk in the market about costs and management fees. Key here is the scale difference. New Zealand is small. We are at the bottom of the world, and that's still the case when it comes to financial markets. Some of the funds that we see in the US that are what's called 3 basis points or 0.03%, they are 3 times the size of the entire New Zealand stock market. Physically, we just do not have the scale here to be able to operate things at that same degree. We're starting to see improvements in that, and technology and efficiencies help. I'm pretty proud of what we've been able to do with Kernel on the basis that, hey, starting even today, we've been able to lower fees, and we've done that through digitization. I do want to touch on costs, though, probably here on that note. We often tend to look at costs as the thing we see written down, which is the management fee. Well, there are a lot of other costs when it comes to investing. So management fees are just one element of that. That's not the total cost. Tax is another one. What's the right tax structure? If you buy an offshore fund and you're on the top marginal tax rate, you could be paying a lot more tax than using a local PI fund. Now, that could actually be worth the equivalent of 0.25% or more, actually, for the really top new marginal tax rate at 39%. So that's kind of the hidden costs that you need to also consider, because you may think you're paying a lower management fee, but you could be paying significantly more in tax. You may be paying trading costs or custody costs. What are you paying for foreign exchange conversions? There are all these things that, I guess, eat into investors' returns. When it comes to Kernel, what we were really conscious of when we set up was, how do we minimize all of this? Not only the management fees, but try and reduce all of these other costs. Tax is a really boring subject for a lot of people, but we created a tax calculator on our website to help you compare the types of tax that you would actually pay through different investment structures, depending on the type of investment strategy you go into and what your personal tax rates are, because it is different for everybody. But we know from a fund point of view, there were things that we could do to try and minimize this. So for example, all of our international funds, we don't invest into an offshore fund. We physically buy every single company that's in the index, and we will match the index directly by holding each of those companies spread around the world. That's a really key thing, because if we didn't do that and we're investing into another fund, there can be quite a bit of tax leakage, because we wouldn't be able to claim the foreign withholding tax credits. Now, tax, not everybody's cup of tea, but do have a look at the calculator. Do reach out if you've got any questions. These are the hidden costs that can eat into returns. So just focusing on the management fee isn't the only thing that you need to do. You do need to look at some of the other costs that come on board. And I guess on that, I should have said at the start, we are obviously touching on a number of topics tonight. The whole point is that hopefully each and every one of you will walk away with at least one thing that's of value and interest to you. So do fire away with the questions, and we are available online after the event as well to answer any further questions. So when it comes to the investment landscape, one of the key questions that you'll be asking yourself is, well, what is your investment horizon? That's probably the key first question. That's going to really determine where you are on this investment spectrum. Down one end, you have lower risk but lower expected returns, so cash. And yes, you can get an on-call or term cash account for 0.75 at the moment, up to the other end with shares. And so these are the 10-year returns. And this is the 10-year New Zealand residential property return from CoreLogic. It's interesting, right? So over this period, shares have actually done, or New Zealand shares have done better than the New Zealand housing market. And that's been pretty common across our time periods. And we see that, and it's kind of expected in most markets that shares will do better than the housing market. But the key fundamental difference there, obviously, is that when you invest into a property, you're taking on leverage. By that, we mean that you're not buying it all with cash. You're using debt to be able to purchase that. So the return on the total value of the property is going to be far higher because of the fact that you've got that leverage. But this is the key question: when do you need the money? If you've got short-term cash needs, you're purchasing a home, you're wanting to fund a wedding or some travel or change of car or medical, you do need to be down this end of the investment spectrum. You're not going to get much of a return, but the money is going to be there when you need it. If you've got time on your side, you can start to look up here. And that's really going to be the key to how to build long-term wealth. Obviously, I think as mentioned at the very start, you do need to think about doing more with your money if you want to achieve your long-term financial goals. And on that horizon piece, I think there's a couple of really interesting things to think about. One of the key questions here is, well, how much bonds should I have in a portfolio? We're seeing that a bit. And I guess some context, Kernel works with financial advisors as well as everyday investors. We work with institutions, and so we see all sorts of things going on across the country. What we're seeing a lot of is actually people going, well, actually, given where interest rates are at, given the fact that you're not going to get much of a return from your traditional income part of the portfolio in bonds, particularly if rates rise, that could actually have a negative return. We're seeing people rethink how they go about their investing. They may be actually putting the short-term cash needs into the cash and term deposits, and then thinking about investing the rest, treating it almost like a mental bucket of splitting the two. The key with that investment horizon piece, obviously time is your friend because you need to be able to ride out the ups and downs. And the other key to that is obviously not reacting to the short-term noise. But when you look at the product disclosure statements and when you're looking at investment options and you're looking at managed funds or KiwiSaver, what you'll often see in there is a little reference date, and it'll be some sort of indication about how long you should consider investing for. And so that could be anything. It could be 5+ years, 7 to 10, etc. Where have these come from? Well, it's to do with the historic risk. I think the key thing for people to remember here that if you look at the New Zealand equity market, there's never been a period of about 6 years where if you'd held your investment that entire time, you would have made a loss. That's the key here. Time is your friend. This is why we talk about having time on your side. And if you've got time before you need to touch the investments, you can consider investing at this end of the spectrum and consider the different investment options that are available to you. Be patient with it, ride the ups and downs. And I guess there are also things that you can do if you're at this end in terms of how you go about selecting investments. So we think about people who are getting close to retirement. One of the common things we actually often saw was, well, people would get to retirement, they may have had their KiwiSaver, and then they go and put it all into cash, or they'll go and put it all into a term deposit. When you're thinking about this horizon piece, do consider actually when you need all of the money. If you're just wanting to generate an income from this, it's not like when you hit 65, you're going to go and spend all of that money on day one. In fact, you're only going to touch part of it, and the rest you may not want to need or not need to touch for 10 or 20 years. In New Zealand, about 30% of New Zealand females will live into their 90s, and it's about 25% of New Zealand males. So you could have a 30-year investment horizon still for part of that money. So do think about that when you're considering what sort of investments that you want to be going into. If you are more conservative as well, there are types of equity investments and share funds that may be more what's called defensive. So they have less ups and down swings. So these may be more higher dividend strategies, or these could be separate asset classes like infrastructure or listed property. Historically, these have tended to have had less volatility, and so these are ways for you to also still invest into higher expected return products, but maybe without as much of the ups and downs that you would normally see from just owning direct shares. So these couple of things to think about. Basically, in short with this, it's your investment horizon that's key. It really sets the scene as to where you should be thinking about putting your money on this sort of spectrum. Another really common question that we will see is, particularly in this current environment, is should you pay down debt or invest? And this is a really common one, probably with people that have got a home loan. Now, if you've got debt down here at the sort of 20% range, credit cards, car loans, obviously pay this off. But when you're in the middle here, people will often go, oh, well, should I be maximizing paying down my home loan or should I be investing? Now, these are the 5-year rates here, folks. I guess the key here is this is actually another one of those things that's quite simple from a mathematics point of view. If the expected return from the thing that you're investing in, which in this scenario, in this sort of simple graph, is the green end of the spectrum, if that expected return is higher than the cost of the debt, then you can prioritize investing, and that will maximize every dollar that you've got, basically. Now, the key couple of caveats to this. this is only an expected return. Nothing is guaranteed. If you're seeing any investment that's guaranteed, be cautious. So the expected return from any sort of investment is not going to be guaranteed, whereas the cost clearly is. The cost of your mortgage is always going to be there. But again, if you're comfortable with that, you can take on some investment. Thinking back to when we talked about what performs better over the longer term, well, shares in New Zealand have outperformed property. So all you're really doing by prioritizing, say, cash flow on a weekly basis or a monthly basis, rather than trying to pay down your mortgage as fast as possible, by deviating that and investing into a well-diversified investment portfolio of shares and other assets, you could expect a higher return over time. Now, I do want to say with this, though, debt is really personal. While mathematically and sitting here and looking at a table and going, look, we expect to earn more from shares over the long term than the cost of the property, well, we will try and put more of our cash flow into our investments and just pay down the minimums on our mortgage. That's quite a simple approach. It doesn't consider the personal element. And we know that debt can be quite overwhelming for a lot of people. So if you just don't like the idea of having debt, if you don't like the idea of carrying a mortgage, it creates stress, or if you feel anxious about that, clearly do prioritize paying that down. This is just about how can you maximize every dollar, but you can't discount the value of your own personal comfort. This is what you need to think about, is how do you, where do you sit and where's your comfort levels? And I guess one of the key things with that is talking to your partner as well, because often if you're in a relationship, you'll have differing views on what your values are, what your priorities are. This is actually where a financial advisor can play a really key role. They can almost act like a therapist, where couples can finally actually talk to each other, because maybe they never really open up about how their views on property or investing or debt. So do take the time, and I think that's one of the key messages of Money Week as well. Why don't you leverage into shares? Well, look, you can in other markets. Look, there is nothing against that. By not prioritizing paying down a mortgage, if you've got a mortgage, and investing, you kind of are doing that. You're taking what would have been payments into the mortgage space and investing into shares. We don't have very many leverage investment options in New Zealand. A couple of platforms do offer it. So that is something to think about. So a number of things around this. It is very personal. Obviously, interest rates will change. Investment returns aren't guaranteed. So do think about this. Talk to your partner about it. Think about what's important to you and what you want to do with your money over time. But that's a simple one there. So is there a couple of questions here? I think the team are obviously getting to that as well. Should you ramp up my mortgage to buy the 100? Look, I wouldn't necessarily go out in there and be saying, go and take on debt to go invest in shares. It's more about, well, where do you prioritize the cash flow? That's the common question that we get. And obviously, as we talked about, the varying risk levels with these two things. We'll come back to any questions that we have on that at the end. Like I say, we've got plenty of time. I'm in no rush to go anywhere. I'll just be moving back downstairs after this, so I'm happy to stay as long as you are. But I guess one of the other really interesting things we've seen over the past few years has been the rise of sustainable investments. Now, sustainable investing has been around for quite a while. Actually, there's references back to the 1700s. So what we've seen, though, is there's been kind of a change in sustainable investing. 60s and 70s, we sort of started to see the rise of sustainable funds, and that was on the back of, say, apartheid and the Vietnam Wars. All of the strategies around then was really about an avoidance. It was about not investing in sin stocks, as they've been known. So that's weapons and fossil fuels and tobacco. What we've seen over the last 3 or 4 years is a shift to ESG, environmental, social, and governance. This not only considers the screening elements about avoidance, but does what's called advance. This is where individual companies are scored. An individual weight is given to them. So typically you may get a 0 to 100 score. Companies are measured across their environmental, their social and governance elements. So this could be how they're managing emissions, how much carbon are they producing, what are they doing with waste, what's the pay ratio between CEOs and senior management and employees. All of these things factor into creating a score of a company. Companies that score well would have a higher weighting in the investment fund. Companies that score low would get down weighted. If you think about a crude but simple example would be, think about utilities in New Zealand. Meridian, high use of renewable energies, would be upweighted. Genesis, coal usage, would be downweighted. Now that's obviously just pointing out one element. There are about 1,000 data points that go into considering each of this. But what we've seen is this shift from just purely exclusionary to ESG. And I guess this is really a reflection of the world is not black and white. There is a lot of transition and change, and how do we measure that? How do we measure change over time? And how do we be engaged with it? Why have we seen such a rise? Well, there have kind of been three forces that have all come together at once here. We've now got the data so that we can actually go and measure these things. So we can go out there and measure the carbon intensity of companies. We can measure and report on the pay ratios. The data and information is increasingly available to actually be able to construct these investment strategies and these ESG indices. In fact, we've just launched New Zealand's first NZ 50 ESG index. So check out our website if you're interested in that, in terms of understanding what goes on with it. The other key one is obviously clearly consumer demand. There's been a big shift in awareness of our role in the world, the impact we're having, and consumers are looking for more sustainable solutions, not only with investing, but across their lifestyle. The other big one is regulatory change. We are seeing regulatory action now taken around the world, which is driving a shift towards sustainable and ESG investing. I'm just going to give a couple of examples. I guess it's a reflection as well of how quickly the world is moving. If we look at EVs, I think this is a great sector to highlight, well, not only how quickly things have moved, but also the regulatory elements as well. If you think back 5-7 years ago, really, and you were told that the world is needing to shift towards sustainable, renewable transportation, you probably thought of a Prius and really were not convinced that we were going to be able to get there. Well, just look what's changed in just the last 2 to 3 years in terms of the number of providers offering, very stylish, high-performing electric vehicles, Tesla and others, of course. We've also got the regulatory element. A lot of Europe has now banned the sale of internal combustion engine cars from 2030. The recent Climate Change Commission report here recommended the banning of internal combustion engine cars from 2030 and no later than 2035. So we're not that far away from this. Again, from a regulatory intervention, we're seeing things like the fee bait coming into play that is going to influence consumers and how they're purchasing, and therefore also your investments. Now, what we used to see was, I think, particularly back in the 60s and 70s under this avoidance strategy, was people were concerned about, well, is sustainable investing going to impact my returns? By not holding these companies, am I going to get a lower return? Now, that's really been debunked, particularly over the last few years. We've seen a big shift now. And even if there was previously a lot of the research now, even McKinsey is highlighting that actually what we've seen is some outperformance by ESG. And there's a couple of reasons, I guess, conceptually to think about this. Companies that score well from an ESG point of view are really considering the consumer demand. They're considering long-term future of the world, the products they make, what consumers are expecting of them, how they're managing their waste. And I guess they're acting before they're regulated to act. So what we've seen there is companies that are scoring well under those metrics have had some outperformance, and people are really getting their head around that now. And I guess as a result, what we've also seen from just a consumer and investment behavior is we're seeing people investing into ESG funds, not because of a values decision, but actually because they've taken a strategic view that they think companies and funds and strategies that have this ESG overlay will do better going forward. Another element that comes into that is, look, if we have to start considering the cost of carbon and carbon costs start rising, companies that perform poorly under some of those metrics will be financially impacted. We are seeing that as well locally. If you're not aware, at the end of the year, in December, there are changes to default KiwiSaver schemes. And so not only will default KiwiSaver schemes go from being mandated and set as conservative to a balanced strategy, there are also going to be exclusions in there around exposure to oil and gas exploration. This is government intervention to the default KiwiSaver scheme space. So you can see there are interventions and things that are going on that are going to drive this change. So that's seen the rise of ESG. That's creating a lot of investment opportunity as well. There is a significant amount of investment needed to obviously move towards a clean energy future. And there are a number of elements that come on the back of that. This also leads to a significant amount of disruptive opportunity. And just want to think about coming back to the EV piece here, obviously we're seeing the rise of EVs. I think a great example of highlighting how consumer demand has changed. If you think about the Ford, the F-150 pickup truck. Now, the Ford F-Series pickup trucks in the US have been the best-selling pickup truck for nearly 45 years straight. This is iconic America. You will think of gas-guzzling, pure American large pickup trucks. Obviously, just announced in the last month or two that full electric Ford F-150. Now, that's a significant change from that company. That's a significant signal that the consumer demand has changed, that where the future is going, and for them to basically pivot the supply of this, what is the best-selling pickup truck 45 years into EV. Another really interesting example for those that may be familiar is the engine manufacturing company Cummins. Now, if you're not familiar with it, Cummins is a decades-old company. They are probably one of the world's leading diesel engine manufacturers. They create a lot of the diesel engines that you'll see in boats parked in the harbour. Now, Cummins have realised that their future in the world is changing, and if they don't adapt, they will be one of these 50% of companies that are no longer predicted to be in the S&P 500 in the next 10 years. They are spending all of their R&D assets into working towards a renewable energy future, shifting their big, heavy transportation engines to things like hydrogen. This is the company that realizes that if they don't act, they will be forced to they will have regulation impact or a shift in consumer demand. So, where are we and what is happening with this disruptive change? If you're not familiar with it, and I will just blow this up so that you can see it all. If you're not familiar with it, we are in the fourth industrial revolution. It has been kind of termed the merging of man and machine. PwC has estimated that 32% of American workers are going to need to change jobs by 2030. That is 45 to 50 million Americans needing to change what they do for work within the next 8 to 9 years. What we're seeing here is a booming of what's defined as these new economies, tire disruption to the existing ecosystems. Now, these numbers sound scary, but we've had previous industrial revolutions. The first couple were pivoted around the agricultural space, but in the 1960s was the last industrial revolution, and it was kind of the first wave of digitization. About 20% of the workforce moved into the services sector. So that was a significant shift in the labor market. But what we had as a result of all of this was greater productivity, better wages, and better growth. So these quite scary headlines, significant changes in employment, are actually very positive for our overall economy and our overall society. And these things are really tangible now. So we are seeing sustainable food supplies, bioengineered foods. There are now over 50 types of alternative milks, produced from all sorts of different seeds and oats and nuts. We're obviously seeing the rise of autonomous vehicles, a shift towards clean power. And I guess another interesting one there is space. Just for some context on this, like 5 years ago, if you ask anybody about space, most people would have thought this didn't really seem like a tangible, big commercial frontier. But most people now will have seen the Starlink chain of satellites traveling across the sky. So this is a fundamental shift in terms of the world that we operate in. And so what investors can do is obviously with this big change in companies falling out of the S&P 500, and so for further context of that, the average lifespan of a company in the S&P 500 was about 67 years at the end of the 1950s. From memory now, it's down to 24 years, I think, and predicted to fall down to about 14 or so. So there has been this shift and disruption of traditional S&P 500 companies. Now, this is what a traditional part of the portfolio is going to be exposed to. If you think about buying a broad world fund or a US equity fund, these are going to be impacted by this disruptive change. And some great case in points just practically. Think about the Blockbuster versus Netflix story. An entire industry and services company disrupted by new technology. So one way is you can kind of think about how do you invest in this? How do you get exposed to this is through thematic funds. And we're seeing a rise of thematic investing, not only within everyday investors, but also within pension schemes. Now, thematic funds, unlike broader funds, as the name implies, they're investing towards a theme. So rather than just owning, say, US equities or a total world, they're buying companies that are tied and connected towards a certain theme. So this could be buying a clean energy fund, or it could be buying a whole disruptive technology fund that's investing across these new economies. Now, when it comes to these thematic funds, again, these tend to be more volatile. What we would say is these are the satellites. So going back to the very early couple of slides, this is the couple of percent allocation around your core. This is a great way to have some exposure to this disruptive change, but realizing that these are going to have some swings, up and down swings over the next few years. The realization of the theme itself may take time. So that's one of the things to think about. We're bang on time. We've obviously got plenty of questions to cover, I'm sure. So what should you think about now? Well, look, if you needed to go see a doctor, well, same when it comes to financial services and advice. Go and seek professional advice if you need it. There are a great range of independent advisors across the country that can help you answer those questions that you may be struggling with yourself. And that's around, when do you need the money? Should you be paying down debt? How are you going to fund your retirement? They are experts at considering your personal situations and assisting with that. Do remember, you're only human. Investing can be emotional. Try and avoid the short-term noise. Time is your friend, and thinking about building a good core long-term portfolio, setting that up and not reacting to the news and the day-to-day movements of the market is key. Make sure you continue learning. That we publish a lot on our blogs. Kat and Christine and our team also run a great podcast, It's No Secret, that talks broadly around a range of financial topics, not just investing. So do check that out. Don't over-engineer it either. We often think that investing is like every other facet of our life, where the more we do, the harder we work, the greater the returns. Well, actually with investing, good investing is really quite boring. It's about finding and putting together the key investments that you need and letting it do its thing over time. So don't touch it too often, don't react. And also, like a lot of other elements in our life, we often think the more we pay, the more expensive the car, the more valuable the house, the better it is. Well, when it comes to investing, fees eat into your returns. And so keeping costs low, and that's not just the management fee on a fund, that's the entire costs that come with investing. Minimizing that where you can is also key. So think about all of those elements. Do feel free to reach out to us at any point in time. We are just one of many options in the market, and you can speak to an advisor. We can't give you personal advice, but we can talk to you about products. We can direct you where you need to go if you've got any material questions. But we do love chatting, whether it be on phone or email. So on that note, if there are any other questions, I'll have a look through what we've got here. But fire away with anything that you want to talk about that I haven't yet covered. So I'm just going to look back through the questions here. What have we got here? So Bruce Ping, diversified index fund is typically not considered as high risk, though, with a long-term horizon. Look, I think that's key there in terms of broadly around diversification, right? So obviously we talked about the risk of associated with just holding one share versus obviously having a well-diversified portfolio. When it comes to diversification, I think sometimes people get a bit confused about this. The key with diversification is ensuring you are spread across different markets and different asset classes. You don't need to buy a dozen funds to do that. You can do that with 2 or 3 well-diversified funds in themselves. You want to avoid too much overlap, because then you actually are increasing the risk. So think about how you spread your investments, selecting a couple of funds and just getting started with that. Obviously, yes, we talked about the risk. The yield thing's interesting. So obviously, mathematically, assuming that interest rate is low, putting money into index will provide high yield relatively to aggressive paying mortgage. Now, the yield thing's interesting. Obviously, there are varying investment strategies out there. If you are after yield or income, you can get index equity investment strategies that higher income. You can also look at whether you want to continue to reinvest dividend options as well to grow your long-term wealth. In terms of, are there plans to launch fixed income? Look, fixed income is a challenging space in this environment. If rates start to rise, you can potentially have negative returns from that investment. So what we are seeing actually is, well, let's build some really great growth parts of the portfolio, the income parts. If you are more conservative, we've got some things like infrastructure and property funds that kind of have some inflation protection and maybe less volatile. But fixed income is challenging. So another way to think about that as well with the horizon, and we're seeing this actually with financial advisors, is going actually short-term cash needs, anything for the next few years, we're going to put into term deposits and cash, but we'll invest the rest. And then you can have those two buckets and manage it like that. So how does S&P rate New Zealand companies on ESG criteria when most companies are not yet disclosing a lot? For example, even emissions are only available for about half of the NZX 50. Now, this is a fantastic question. You're right. There is a lot that needs to be done around disclosure. That is changing. A couple of key things here. There is one big set of disclosures that's currently sitting in select committee at the moment, but already been passed, and that is the Task Force for Climate-Related Financial Disclosures, TCFD. Now, this is a global initiative. TCFD will basically mean that in the current drafting, all New Zealand listed companies will have to be considering climate change, climate-related risk, establishing a governance and risk management framework, and then reporting a bunch of metrics on this. In terms of the ESG index, there are a number of elements that come into it. We've written a couple of blogs, and I'm more than happy for you to send us an email, reach out to us, because S&P have also written a couple of summary blogs that talk about the methodology. But in short, the things that go into it, one of the big inputs is a thing called the Corporate Sustainability Assessment. This is a comprehensive survey that goes out to over 11,000 companies around the world. March last year, only about 24 of New Zealand companies were covered under this. That's what we've been working with S&P on over the past year. That's now at the full 50. That covers and reports on all of the key elements around things like the management ratio, pay ratios, etc. It looks at the environmental elements. Carbon is measured by a company called TrueCost. TrueCost covers about 15,000 companies covering Scope 1 and Scope 2. So you get some pretty comprehensive emissions targets out of that. There's also input from Sustainalytics, and they are assessing how the New Zealand companies sit in comparison to the global peer group under the United Nations Global Compact. So there are a range of basically global leading data sets that come into this, and that then results in creating an ESG score. The ESG scores, the weighting that goes on to the E elements and the S elements and the G elements differ between sectors. So utility companies may have a greater emphasis on the E, where say telecommunications on the G. Now, I guess one just high level thing on that around the ESG element, what we are seeing globally is a lot of M&A activity in this space, because the nice thing about getting these large global data sets now is that you can actually have quite accurate modeling. So TrueCost, as an example, can measure carbon on, I think, nearly 500 business lines. But say, for example, you saw an input from a company, but when it goes into the system in the database and you've got 15,000 other companies around the world, it gets flagged as being unusually low. You can now override that. You can challenge that data with the company. That's one of the great values of having these big data sets now, is that it's a lot easier to model and go, well, this looks unusual compared to the peer group or against the industry. Are they reporting accurately? Is there something wrong here? And let's override that. So hopefully it touches on it. If you've got some detailed questions around the New Zealand ESG index we've developed, reach out to us and I'll share all the information. What is the plan for Kernel to grow its fund? As fund grows, are there plans to reduce fees or increase rebate? Well, we have been growing exceptionally fast. I, in fact, think we are when I looked at the last 6 months, we're the fastest growing fund manager in New Zealand. So we're very proud of the support that we've got from investors across the country. And our investor base has been growing their average balance with us by about, I think, $1,200 to $1,500 every single month. So we're seeing a lot of people really using Kernel for that long-term wealth building, regularly contributing. We also work with advisors and charitable trusts and iwi, so we've got support from so many channels. And what you've seen is our recent NZ ESG fund actually was the most recent fund, but because of the scale and support we've been building, that's also our lowest fee. So investors with us, as you know, there is a rebate when they're over $25,000. So that fee effectively drops from 0.25% to 0.15%. And obviously with us, there are no transaction costs, there are no trade costs or any other costs as well. There is the monthly member fee of $3, but you can buy and sell. And that's why we see a lot of investors regularly investing with us and building their long-term wealth. Philip, NZ20 looks a good long-term investment, but could it be better to use this list and exclude stocks in this index that are not obviously ESG focused? I'm interpreting that as could we have done the ESG with NZ20? The problem with the ESG was that what we're doing with the NZ50 ESG is that companies that score well, it's basically within the sector. So if you look at our NZ50 ESG, if when the index rebalances, there was 20% in the normal 50 portfolio index into utility companies, there would still be 20% into the NZ50 ESG fund into utility companies. What we will have the difference is the weightings of the companies will be slightly different based on their ESG scores. So we had to have a larger fund to be able to do that weighting up and down of each company's. Should you avoid funds that have a lot of exposure to companies that you may already hold? Yeah, look, that's a key one, right? Coming back to the same thing about if you're buying multiple funds, if you're buying lots of funds, you could be at risk of overlapping each of those. And all of a sudden you don't realize it, but you may have quite a large exposure to a certain sector or companies, and that wasn't your original intention. So you do have to think about that, think about the proportion of that overlap that you may have. So yeah, as mentioned, that can create a bit of work, but once you've kind of got it set up and you know what's going on, then you should be pretty comfortable going forward. When it comes to index funds, most broad index funds, most global, so well-diversified index funds will do what's called a rebalancing sort of once a quarter. And that's at that date that you could have a change, typically a change in the company. So if you think about the NZ20, at the end of the quarter, it could be that company number 20 has fallen in value and company number 21 has risen in value. At the quarter is when the change would be made and company 20 would be dropped and replaced by company 21. So you may want to keep an eye out for those changes as well. In terms of index funds, so we do publish all of our holdings on our website, typically within the first week of the month as well. So you can see exactly what you're invested in. And you can also see that on the dashboard as well. And we'll show you the dollar value and percentage. What affects the tracking of fees as you compare to an index then after tax? Yeah, so what you would normally expect with an index fund is here's the return of the index, and you would expect to get that less the management fee, right? That's a standard job. There are things that we can do that actually do better that. There may be things that people do result in worse of that. There are about 16 facets that control that. Obviously, a simple example of this, and I've written a paper on this, so we're more than happy to share it. We're very conscious of how well we track an index and how well can we replicate it. Think about an index. An index is hypothetical. You know, the index just always gets the last closing price on the day. The index doesn't have transaction costs and trade costs, which we have in the real world. They can perfectly do all the rebalancing, etc. So it's a hypothetical. How do we do that in the real world? If you think about our fund, well, holding cash in the fund, well, the index doesn't hold cash. So if the market is going up and we had 2% or 5% in cash, that is going to mean that the return of the fund won't be as good as the index because the index had no cash while the market was going up. So we really try and minimize all of that. I think we've probably got some of the lowest cash in the market on that. We typically have sort of 0.1% or less cash in our funds at any point in time. So that will minimize that. And then there are things we can do that add some positive. Some of it, I guess, is kind of more nuanced. Some of it's pretty common. Happy to maybe share that offline or send you the paper. Michael Burry has previously argued that passive index fund investing is creating market bubbles. What are your thoughts on this? Bruce, that comes back to, I think, a really understanding of index funds. And that comes back to my earlier point on it's the trading that sets the value of the market and the value of stocks. So a buy and hold of a bunch of shares by index funds doesn't actually force a fundamental change in the market. It's the continual trading that sets it. So what we know is that index fund trading in the US, where they account for about 30 to 35% of assets, they still only account for about 10% of trading volumes. So the trading that's done day in and day out by mainly institutions, but everyday investors and pension schemes, that's what's setting the value. So it's very hard to see how the indexing causes that bubble. The other thing that I think there's sometimes some confusion around is, index funds and the flows of index funds just will keep driving up the price of the largest funds because they're a bigger weighting. Well, no, what happens is you're giving a proportionately equal amount to all of the companies into the capacity that the value of the company can take it. And there's a great article, I think it's called The Slings and Arrows of Passive Investing. It's by S&P, and you can Google that in their indexology blog, and we're happy to share a link to that or email it out. That highlights, again, I think just a misunderstanding, even by industry experts, around the mechanics of how an index fund works. S&P works with Sustainalytics and Truecost. Seems strange as they are competitors. Sustainalytics, well, S&P actually acquired Truecost a couple of years ago. They also acquired SAM, the scoring agency, as well. And this is what we talk about. A lot of M&A activity has been happening within the ESG space because companies are looking to build these really robust global data sets. You know, they really want to have the large amounts of data that they can model accurately then and challenge company reported data, as well as try and make predictions as well on the back of that. What else we got here? How do index funds operate without trading fees, given the amount of units bought and sold per week? Perfect. So when we launched our global index funds, we, rather than have a buy-sell spread, so with some funds, what you'll see that are not listed on exchange, you will see they will have, and I'll touch on this slide actually, they will have a buy-sell spread, and that could be 0.05%, 0.1%. When we launched the global funds, we actually said, well, we will cover the trade costs out of the management fee. So we keep things really clean and simple for our investors. We have a GST inclusive management fee. We've covered the trade costs out of it. So for the New Zealand funds, we take that out of the fund, but we've modeled it to be exceptionally low, and we're very conscious of that as well. So all in all, when it comes to things like tracking and how do we minimize tax, how do we deal with trade costs, we've really tried to address every little element that will impact investors' net returns. And I guess on that, this just highlights a couple of the difference between an ETF and an index fund and why we set up as an unlisted index fund. For those who aren't familiar, my background actually was working within ETFs here in New Zealand for a number of years. I was at the NZX for about 6.5 years. Listed ETFs in New Zealand are taxed at a flat 28%. Now, unfortunately, that means if you're investing for a child or investing for a charity or somebody like that that has a zero tax rate, it can be overtaxed. So we wanted to be an unlisted index fund so that investors were taxed at their appropriate tax rate, their PIR. So you will elect with us your exact PIR and be taxed at that rate rather than taxed at 28%. If you are obviously on a lower rate, you can claim back credits from holding the New Zealand-based ETFs. But again, if you have a child or somebody that doesn't have other income that they can go and use those tax credits against, then it's not that valuable. The other nice benefit about being unlisted is, as sort of touched on for you there, Trent and Taylor, was there are no transaction fees. So you can get an international exposure through Kernel and you're not having to pay transaction fees. You don't have to pay foreign exchange fees. All of that stuff is kind of entirely minimized or removed for investors. Yes, obviously you don't get the benefits of being able to trade the fund in real time throughout the day. But for us, it was about how do we make these the most efficient structure for good long-term wealth building, either if you've got lump sums or if you're regularly investing. So that's how we ended up in the structure we are. That's also why we physically replicate the global index ourselves and not wrap up an offshore fund. And final little point on that, just to be clear around the terminology, ETFs mean exchange traded funds. It simply means that the units in the fund can be bought and sold on a stock exchange. It doesn't mean necessarily that it's an index fund. An ETF could be either actively managed or an index-based strategy. So you need to look through to make sure that you're getting the solution that you're after with that. It looks like we've covered plenty of comments here. Bruce, our funds are actually already available in a KiwiSaver scheme, so not operated by Kernel, but through third parties. So we can definitely recommend people if they want to find an advisor or how they want to access Kernel through an index fund. So hopefully that's been pretty comprehensive. And as mentioned, we've touched on a range of things. It is, I guess, the whole purpose of this was to give a broad overview so that there was something that each of you could take away from tonight's event. Unfortunately, we couldn't do it in person. I really enjoyed the last couple of weeks we've been able to engage with everybody at the event, answer questions as we were going in person. Hopefully it wasn't too clunky sitting at home. You've been able to have a nice cold drink, and it's probably now time to go and cook some dinner. Tomorrow is Friday, so enjoy it, and hopefully we'll have some great news and be out and about in person soon. So if we didn't get to or weren't coming to an area that you were in New Zealand, do let us know, because we're more than happy to organise a session somewhere near you. Even last week we were in a little in Te Awamutu, fantastic little event there. So we will go anywhere around the country, so let us know, and hopefully we'll see you in person again soon. Finally, do reach out. Again, like if you do have any questions, feel free to reach out to our team. Here are a couple of the details here. Send us an email through our website. Contact us on LinkedIn, Instagram, wherever it may be. We are always available. So thanks again, everybody, and go and have a great evening. And we'll see you again in person soon.